Have you ever wanted to protect your stock portfolio from a sudden market drop without selling your stocks? In today's video, we're going to discuss one of the more powerful tools, but often misunderstood tools in the trading world, and that is the 3X Inverse ETF. Yes, that is a mouthful, but by the end of this video, you're going to know what it is, how it works, and how it can be used as a hedge in volatile markets. Hello everyone, welcome back to my channel. I'm David, and my mission in life is to help investors better understand the strategies and tools available to them to grow and protect their wealth. Now let's break down this ETF strategy. Now ETF, or an exchange traded fund, is essentially a basket of investments that trades like a regular stock. Now, an inverse ETF is designed to move in the opposite direction of the market or the index that it tracks. If the S&P 500 drops by 1% in a single day, a standard inverse ETF like the ProShares Short S&P 500, symbol SH, will rise by 1%. So think of it as a way to profit when markets go down. Now, when we add leverage into the mix, the situation gets really supercharged. A 3X Inverse ETF, as the name suggests, is designed to deliver 3 times the opposite move of the daily underlying index. For example, let's talk about the S&P 500 dropping by 1% in a single trading day. The 3X Inverse ETF, such as the Direxion S&P 500 Bear 3X, symbol SPXX, would aim to rise by 3%. Now on the flip side, if the S&P 500 goes up by 1% in a day, that same ETF will lose about 3%. So it is really important to highlight that these returns reset every day as well. So they are designed for short-term trading or hedging, not long-term holding. So now you may be thinking, why not just sell my stocks if you think the market's going to drop? And that is an excellent idea. It's something that needs to be considered, but the reality is that many investors do not want or can't afford to sell their positions. You might have significant unrealized gains, and a sale would trigger unwanted taxes in a regular trading account, a regular taxable account. Or maybe you're a long-term investor and you do not want to disrupt your core holdings. This is where an inverse 3X ETF can step in and give you some help. By buying shares of this type of ETF, you can offset some of your downside risk in your portfolio. It's basically a way of buying short-term insurance against market volatility. If the market drops sharply, the gains in the inverse ETF can help balance out some of your losses in your existing positions. Now, let's give a word of caution here. The 3X Inverse ETFs are very powerful tools, but they're double-edged swords because they use leverage and reset every day. Holding them for more than a few days in a volatile market can lead to results that do not perfectly match what you might expect. They're best used for short-term tactical moves, not as a permanent piece of your retirement portfolio or any portfolio, even your trading portfolio. Like options and futures contracts, they require discipline and active monitoring. So let's sum this up. An inverse ETF goes up when the market goes down. A 3 times inverse ETF magnifies that move 3 times in the opposite direction. They can be used as short-term protection if you want to stay invested in your stocks but guard against a market correction. Now, with this video today, we've only really scratched the surface of ETFs, and particularly inverse ETFs. So with subsequent videos, we'll dive deeper into how to use these instruments to protect individual stocks or your entire portfolio. And we'll use some practical examples to keep in mind. You do not want to miss these upcoming videos. So thanks for watching. And always, these videos are for educational purposes. Always be certain that any strategy or any investment product will work for your personal financial plan before acting on it. Okay, we'll see you next time. Y'all come back.